Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amendury, and we're joined today with a very timely special guest, someone that has contributed to our show for years now and is a trusted owner of Miles Franklin Bullion Dealer. His name is Andy Schectman. It's where I get my precious metals from. And actually, I was thinking about one of my favorite interviews I did with him just a few years ago, where we really dived into, the nuances of storage, the pros and cons of having it at home, the pros and cons of, storing it elsewhere. And it was so insightful. And I'll actually link to that in the description area here. One of my oldies but goodies interviews. But we're going to be talking about what is going on in the markets right now. Precious metals shortages, what's going on with the stock market, the panic, and really what are major bullion dealers seeing. And Andy's a great person to talk to. Really everyone wants his attention right now. So I'm super grateful that he took the time to be on Crush the Street with us. So Andy, thanks for coming on the show with me today.
Wouldn't miss it. Glad to be here, Ken. Thanks for having me, buddy.
Well, I'd love to just chat with you as we go through this interview about the multiple paths gold has for it going forward here. But before we do, let's chat about what we're seeing right now in gold. I mean, gold had a massive move this morning, moved up from, below 1,700 to now above $1,700 in just a very swift move. And that's what we're starting to see, these swift moves in gold here. But, talk to us a little bit about what's going on with the price, but I'm really interested in what's going on with the buying as well.
Absolutely. Well, I think any discussion on gold, Ken, has to center first and foremost around what I consider to be the most game-changing watershed moment of my 30-year career. And for some reason, it doesn't get enough attention whatsoever. It should be getting a whole lot more. Anyone who owns gold ought to really, really understand what happened almost a year ago to the day. And I'm going to take you back a little bit to kind of set the stage for how significant this really is. So when I think back over the 30 years that I've been doing this, probably the one question that I had the hardest time coming to grips with was, why the hell were the central banks always so willing to unload their gold? Could never quite understand that. In fact, even in the early part of the 2000s, right around 2000, all the central banks signed on to something, all the Western central banks signed on to something called the Washington Agreement, which was an agreement that would limit the amount of gold that each central bank could sell to the market to 500 metric tons. Now, this was done to not destabilize the gold market, to specifically allow the banks to sell their gold, but not to crush the price. And it never made sense to me why the most sophisticated traders on the globe were always looking to shed their gold and in favor of treasury bonds and equities. And in fact, through 2017, that was a trend that pretty much continued unabated, continual selling by the central banks. And then all of a sudden in 2018, something changed. And in 2018, the central banks as a community bought more gold than at any time in the previous 60 years combined. 2019, that trend went up by 90%. And then in April of 2019, quietly through the Basel-III agreement, where the central banks all meet at the Bank of International Settlements in Basel, Switzerland every year to discuss guidance going forward. And they reclassified gold quietly as a tier 1 asset. Now, that is incredibly significant. You see, there were 4 reasons why the central banks would want to continue to sell their gold up through 2017. Number 1, paid no interest. Number 2, it was unpredictable in its movement. Number 3, it cost money to store. But the tier 3 assets rating of gold prior to 2019 was the biggest reason. It would only allow the central banks to declare 50% of the value on their balance sheet. And so that denigration of the balance sheet would inhibit their ability to sell bonds and transact international business. So most of the central bankers up through 2018 would have had no problem shedding their gold in favor of the only other tier 1 asset on the planet, which was US dollars and US treasuries. So basically, the bottom line is the most sophisticated traders on the planet all of a sudden have reclassified gold as the only other tier 1 asset on the planet. Let that sink in for a minute. The ultimate form of collateral a year ago. So the central banks really since 2018, they front ran it for a year, have been voraciously accumulating gold and putting a floor underneath it. And every pullback to me is just an opportunity for people to add to their portfolios, simply speaking, because the most sophisticated, well-funded, well-informed, influential traders on the globe have found it significant enough after 80 years of the dollar and the treasury market being the only tier one asset status to reclassify gold. And I ask you, why would they only choose gold, not a special drawing rights from the IMF or a euro or a yen or any other currency or asset class? They chose gold. And so to me, first and foremost, the most significant event of my career is the reclassification of gold. And it tells you what the central banker's long game is for the price of gold. And anything else that we talk about gold should start from there. Because when you see things as unstable as they are right now, when you see a Keynesian-based economy, one that is all centered around consumption, debt, and spending, when you see the engine of spending and consumption killed and shut off as it is right now, and a reclassification of gold is the only other tier one asset, I think you need to pay attention. To me, it's the most significant thing I've ever seen. And I think from here, the sky's the limit for gold. When you talk about what the central banks have in mind going forward, we could have a long discussion about that. But in terms of what I see with gold, I think that it's just beginning. And the central banks and their acquisition and their reclassification of that, to me, certainly put an exclamation point behind that. So as far as what's going on in the gold market right now, it's insanity, complete and total insanity, Ken. I've never seen anything like it.
Simple question. Who's buying?
Everybody. Nobody's selling. As far as retail demand is concerned, we've been selling to the choir for a very long time, for the last 5, 6, 7, 8 years, really since 2011 when it started coming down after its peak. It's been the choir that's buying it. The mainstream isn't. And I would argue that we are now 10 rows deep into the audience. All of a sudden, we're getting phone calls from mainstream people who are asking. And this brings me to a point that makes me really concerned. In fact, if I had to express one concern, this would be it. And it is that over the past 12 years, since 2008, the easy money that the Fed has thrown at the United States economy has all gone into asset price inflation. Easy money and low interest rates has translated into all-time highs in stock market and bond market and real estate. That asset inflation is now translating into price inflation. Let me explain. For the very first time, we're getting people pulling out of the stock market. And you can probably notice the great volatility we've seen lately. The Fed comes in, pushes it up, and then you see it, up 1,000 points and maybe down 1,000 points the next day. That down 1,000 points the next day are the people who have made all sorts of money, the baby boomers, made all sorts of money over the last 12 years, saw half of or a third of their wealth evaporate in 3 weeks and got nervous. They're pulling out of the stock market with all of this money, looking for a place to put it at a time when the supply chains across the globe are all broken. That money coming out of assets will now create price inflation. And we're seeing it in real time in my industry, with premiums higher than I have ever seen before, ever. And the question is, are those premiums too high or aren't they? You and I were talking offline about there are rumors or there's whispers that the dealers are taking advantage of people because these premiums are so high. I don't think they are. I mean, are they or aren't they? The question really becomes, what do you see getting this engine of consumption and spending reignited? And if the supply chain is broken and continues to stay broken, these premiums and these prices are the precursor to no availability whatsoever. I guess I'll simply say this to you. People have asked me over the last couple of weeks, Andy, how are you able to keep getting product? There are a few answers to that. Number one, I've done this for 30 years, Ken, and I have supply chains that are deeper than just the primary distributors. Most of the online companies work with one primary distributor. And in normal times, those primary distributors who do billions of dollars a year are sufficient enough to stock a JM Bullion or a SD Bullion completely and totally without any problems whatsoever. I've been doing this a lot longer than both of those companies combined. I work with all of the primary distributors as well, but I work with smaller, mid-tier and small distributors and a myriad of coin shops all around the country that has kept me flush on product. But I will tell you this, I am paying more than I've ever paid above melt value, ever, just to have stuff in stock to sell. And so I pose the same question to you that others are posing around the internet. Are dealers paying too much? Well, I'm paying too much, or am I? I don't know. I just had a large distribution. I put every cent of it into Gold Eagles at the highest premium I've ever bought them at in 30 years. Am I paying too high? I don't know. I'll let you decide that question, but I'll ask it simply this way. What gets things going again? I was Diamond Elite on Delta. I traveled so much that I was the highest level of medallion status on Delta. I don't care how much money you give me. I'm not getting on an airplane and going and sleeping in a hotel room and going to a conference that I was supposed to be at next week in Carlsbad. Of course, that's been canceled. But the point of it is what gets the engine going. And if we take it a step further, well, the United States Mint is located in West Point, New York. The Canadian Mint just opened up on a limited basis in Ottawa, Canada. They're way back ordered. All of the other mints are across the Atlantic Ocean, but let's not forget about the fact that the mines are largely closed across the globe. All of the Swiss refiners are closed. This is a situation that is not like 2008, where it was a V-shaped recovery, where Fed-induced credit and easy money turned things around. This is a whole different animal altogether. And I'm very, very, very concerned, Ken, that the viability of my business dries up. I'm concerned that I can't get product any longer. So I will pose this question to you. No, the dealers are not charging too much. And quite frankly, as an industry, we are right up there with grocery stores in terms of the small margins that we always operate under. And I think the dealers are basically feeling the same way I am. We're scared. We don't know what next month holds. I'll put it to you this way. If you called me up today and say, I want to spend $25 million on gold and silver, I'm working on a deal like that right now. All I'm able to do that with are 400-ounce gold bars and 1,000-ounce silver bars. You're talking the stuff that is traded on the COMEX market. $1 million, we can do it in coins, but you get 10, 20 people do that across the industry, and overnight you'll see premiums go way higher and product disappear. That's how fragile the market is right now. So I guess I would answer it in a very roundabout way, Ken. I don't think dealers are charging too much. I think that this is a question that people need to internalize and ask themselves this: when does it end? If it ends soon, if a vaccine comes out tomorrow, yes, you paid too much. If it doesn't, my prediction is in 6 weeks. In 6 weeks, there'll be virtually nothing for anyone to get, because as money pulls out of the stock market, creating price inflation, they're looking for somewhere safe to put it. Where the hell do you put your money right now? With interest rates near zero, with real estate at all-time highs, with the stock market as volatile as is, where do you put it? So they're all coming into precious metals, creating massive price inflation and distortions in the supply chain that's already broken. These days are unlike anything I've ever seen, and I'm dead serious. I don't know what tomorrow holds, so I have zero problem with the premiums that are being charged. I'm buying them myself at that level.
Well, I appreciate that. And it was good to address that, because I know a lot of people, I know there's been rumors, videos and being put out there, and it's good to hear that from you. And it's always a function of supply and demand. People get mad at the, people during hurricanes for charging a lot for certain supplies. And, if you don't, sometimes people buy it all up, right? And then there's none anyways. So, if it's not going to reflect the demand, the price, then there's not going to be any supply for people to buy anyways. So the market always corrects that. So I think that was a great way. And obviously you articulated that a lot better than I did. So you kind of addressed this, and maybe just reiterate it. Short term, long term, if there's a vaccine, this might get turned around here in short order. But what does your instincts say about the shortages that we are seeing in precious metals now, and how that starts to play out over 6 months, over a year? And I know that's difficult. Is it just a function of, gold continuing to stair step higher, or do you expect an explosion in the price? And I know that's two extremes.
Well, no, I think I like the question. First of all, again, I'll fall back on the tier one asset. The most sophisticated investors in the world are accumulating it and de-dollarizing. That's most important. That's the baseline. But I think that as far as the American public is concerned, let me answer it this way. In 1980, with gold at 800 and the Dow Jones at 800, the last time we were 1 to 1, a lot of people, in fact, Pierre Lasson, I'm not sure if I'm pronouncing his last name right, but he is a mining executive. I think he was with Newmont Mining, maybe Goldcorp. I'm not sure. He's a big name in the mining industry, but suffice it to say, I just saw he was talking about 1 to 1 at 10,000 on the Dow, 10,000 on gold. Pick a number. I don't know. That's besides the point. But in 1980, you had a 8% allocation to precious metals throughout the United States. With $800 gold and 800 on the Dow, there was an understanding, a greater understanding of the significance of precious metals in your portfolio 40 years ago. So now, today, the numbers are 0.5%. And so I like math and statistics. And if we talk revision to the mean, the average over the past 40 years would be 2.5%. If we see a 2.5% allocation across the board in U.S. equity portfolio shifting to physical precious metals, it doesn't sound like a lot. So, you know, if you have $100,000, you're talking 2,500 of it goes into precious metals. Not a big amount. That's a 5-fold increase in precious metal demand in this industry that is already having a hard time selling it to the player. What happens when everyone says, I got to get out, I need some precious metals? Now, if you're talking in normal times, yeah, the supply chain would catch up with it. We could handle a 5-fold increase and be happy to do so. Right now, it's terrifying because you see a 5-fold increase, I'll be saying no to half the people I talk to. And that is not what a business wants to deal with, too much demand and not enough product. And the investment demand in the United States could be the turbocharged engine that really sends things flying. I guess the bottom line, Dan, there's a lot of, or Ken, sorry, I was talking to your cousin for a second. There is a lot of demand in this industry that is going to be pent up and I think blow up when the American public wakes up to perhaps the fact that the road to retirement isn't always paved with mutual funds and stock certificates. And if we see a revision to the mean and get a 2.5% allocation to precious metals, just a simple 2.5%, I would say within a few days, there would be nothing left in this industry unless the supply chain opens up. So you got 2 mints in North America, US and Canada. You got a handful of refiners that are already 8 to 10 weeks back ordered across the board, and everything else comes from across the globe. And they say that there is no bull market like the precious metals bull market for one reason. All the other bull markets are centered around consumption and greed, making money. Precious metals bull market is the opposite of that. It's about fear. And the higher the price goes or the scarier the world gets only reinforces people's motivation and desire to hold gold and silver. And so through all of this craziness, in fact, in the month of March, we did almost 6 months worth of business. And not maybe 3 people sold out of thousands of orders. When we're normally doing 30 or 40 a day, we're doing 500 and 600. Nobody's selling at all. And so kind of indicative of what I'm saying, this is when you look at the price is a tool of misdirection by the commercial and central banks. They've been holding down the price for a long time. It is not indicative of demand, which is completely and totally off the charts.
Totally. You know, I look at an SLV right now at 1430. You know, that's got to be frustrating for people that own precious metals and then owning the SLV. But if you own silver, you know, the premiums right now are significantly higher on that. But I got to be honest, it is a little bit draining to see silver in the $15 range at the moment while we're having this pandemic crisis. So maybe address that, the paper price versus the physical price. And is there going to be a realization in the markets where conventionally people just disconnect from the paper price and understand that physical is where it's at?
Yeah, you're beginning to see that on many levels. I'm going to answer that in a moment and just say you're beginning to see that in real time in gold on the COMEX market between COMEX and London. There is already a decoupling. It's been as large as $50 or $60 an ounce I'm going to come back to your question on silver and simply say to you that the decoupling is happening, whether it be in premium on physical metal or in the COMEX market, where in the April contract, there were 28,000 contracts that stood for delivery on COMEX at 100 ounces a pop. Normally it's 5,000 to 6,000. So you're talking almost 6 times the number of contracts that normally stood for delivery, did stand for delivery. And the COMEX market, through the term of rehypothecation, meaning they've sold far more gold bars than there are, or far more paper contracts than there are gold bars. They've rehypothecated each bar many hundreds of times. They didn't have the gold to deliver. And so they changed the rules in midstream, ran to London, and now the rules say if you stand for delivery on a contract that you own in a 100-ounce gold bar that's traded on the COMEX, they only trade in 100-ounce bars, you may have to stand for a fractional interest in a 400-ounce gold bar that's coming from London. So London is basically saying, well, the price that you're quoting on COMEX is not right. It's as much as $50 undervalued. So I've been placing orders with people recently that have been looking at the spot price on various websites and saying, what the heck's going on? You're telling me gold is $30, $40, $50 higher than I see on Kitco? I'm saying, yeah, it is. And if your listeners Google the disconnection or decoupling between London and COMEX, there'll be enough for them to read for a long time. So you're beginning to see that on multiple levels, and that's very frightening. It shows the cracks in the seam of the COMEX market. But as far as the disconnection with silver at the premium and the price of silver, yeah, it's been very frustrating. I'll simply say this. At the beginning, when you look at previous bull markets in gold and silver, gold typically goes first and silver goes further. When you look at JP Morgan, who has amassed over 950 million ounces of silver, that's 9 times what the Hunt brothers tried to acquire, over 9 times. It's the largest single physical position, the largest physical position ever accumulated in silver at one time, as they've held down the paper price. And of course, let's not forget or take the opportunity to mention the Justice Department has already indicted 6 of their precious metals traders on racketeering charges. RICO charges have been levied against 6 precious metals traders on the COMEX market, being accused of running a criminal enterprise. The Justice Department is investigating. Let's hope something comes of it. But this, again, is a paper price disconnecting from reality. And when you see the most sophisticated investors on the planet amass the largest physical silver position in the world while holding down the paper price, it should tell you what their long game is for silver as well. And look, the ratio between gold and silver, Ken, is as disconnected, is as big of an anomaly as anything I've seen in 30 years. I can't think of another asset on the planet that's trading for a fraction of what it was trading for in 1980. Nothing. So I would say to you, regardless of how frustrating it is, and regardless of the fact that the industry tells you can't find anything for under 20 bucks, basically, an ounce, that the paper price is not real. I look at it as probably the single most undervalued asset on the planet, and probably maybe the best possible investment on the planet as well, because it's getting harder and harder and harder to find. And when you see influential traders like JP Morgan finding it significant enough to accumulate as much as they have over the last 7-8 years, to me, it's very eye-opening. So frustrating, yes. Sometimes you have to just have really strong fingertips and hold on and trust your gut and trust your beliefs, because I can't think of a better place to park your money than silver right now when we're talking the long game, 100%.
Andy, let's touch numismatics, because I know that those were trading at, during the boom times in the Trump administration. We were chatting and, we were able to get numismatics for really thin margins based on where they were in comparison to spot price. I'm just curious. This came to me while you were talking right now. How are the numismatics doing in this environment?
Glad you asked. I've been on every podcast for the last year begging people to buy them and trade their gold for it, their bullion. And a lot of my clients did that. They traded their bullion. I did it myself. I traded almost all my bullion for numismatics. One of the things that has made me successful in this industry is exploiting price anomalies. whether we're talking gold to silver ratio, platinum to gold ratio, numismatics to bullion. When you see a price anomaly and you believe in mathematics and statistics like I do, you exploit them, you take advantage of them. That was as big of one as I had ever seen, and I begged people for a very, very long time, trade your gold bullion for numismatics. It's the best value in gold. I kept saying that over and over and over again. Now they're too expensive. They have gone through the roof parabolically. All you gotta do is go online and look at any company selling 62 or 3 grade St. Gaudens or $20 Liberties. They're all north of $2,000, and they'll continue to rise. They were as undervalued as anything I'd ever seen in gold. And kind of like silver is right now. It's an anomaly. And when you talk about price anomalies, typically they don't last very long. The gold to silver price anomaly has lasted longer than I ever would have given it credibility for, as did the numismatic premiums. They lasted for almost 2 years in those really ridiculously low ranges. And a lot of this has to do with 2017, where after 6 years at that point of the market going down, and at the same time cryptocurrencies, which were supposedly cut from the same cloth, going to the moon, like Bitcoin, and at the same time Dow Jones following it, there was mass capitulation, completely and totally mass capitulation in 2017, to where I didn't want to come into work in 2017, where normally 1 out of every 100 or more sales is someone selling to us. In 2017, it was 65 or 70 out of 100. Easy. The majority of all the people we would talk to were selling, and it created a tremendous product overhang in the industry, and created this price anomaly that is now reverted to the mean. And even though they're in line with what they were most of my career, 20-25% over the price of gold, you're talking $300 now. So those premiums, even though percentage wise are in line with the mean, keep coming back to that. The law of averages is there for a reason. If in Minneapolis in the month of January I wake up and it's 90 degrees, I'm not pulling out my golf clubs and my lawn furniture. I know it's an anomaly. Same thing with you in Texas. If you woke up in July to 4 feet of snow, you're not going to go buy a snowmobile. So the thing of it is that these are price anomalies. And if someone wants to have a better chance of succeeding, you exploit the anomalies. You buy silver right now, you consider buying platinum, and you would have bought gold numismatics over the last 2 years, because in terms of gold, I've never seen anything like it. And we have indeed regressed to the mean, and we will see that again in things like silver. So for me, the numismatic potential is in silver right now, and to a lesser extent platinum because of its industrial uses, but silver is indispensable. And the fact that it is as cheap as it is a screaming anomaly, just like numismatics were on par with gold eagles and things that I had never seen before. And I guess when I look at the numismatics, they were right up there with the biggest anomaly I've ever seen, the biggest being silver right now. So for people who miss the numismatic bandwagon, there is still time to jump on the silver side. And even with the high premiums, things don't get better soon, Ken, those premiums will turn from high premiums to unavailable.
Wow. There it is, everyone. Andy Schectman of Miles Franklin. Andy, thank you so much for coming on the show and just sharing your insights with us today. If you want to just close out by just letting people know how they can reach you and a little bit about Miles Franklin, please do.
Okay, a couple of things. Thank you for giving me that opportunity. First thing I'd like to say is that over the last 8 weeks, I have been publicly saying I'll beat every price in the industry, publicly listed companies, online companies. And I'll do that for your listeners. They would just need to email me with "Crush the Street" in the subject line. I will reply to every email I get, or forward it to one of my trusted brokers who I have given the ability to help me with specific deals like this, yours included. And that's number one. I'll beat any price that people find while there's still product available. Number two, as far as Miles Franklin, we have been at this for 30 years. We are in a federally non-regulated industry. It's very important, especially in times of craziness like this, to know who you're doing business with. The state of Minnesota, where we're located, Ken, is the only state in America that regulates the precious metals industry. And even though we are A+ rating, Never had a customer complaint in 30 years and 6 billion in transactions. One of only 25 companies ever approved by the United States Mint to resell their product. All of those accolades we're very proud of in a federally non-regulated industry, but the state of Minnesota doesn't care. They have mandated that everyone who sells precious metals either in Minnesota or into Minnesota must be licensed, bonded, a very large surety bond, and background checked every single year. And that's why most of my competition has boycotted the state of Minnesota, because they themselves would have to be subservient to the Commissioner of Commerce the way we are, with a very large surety bond and background checks. It means you cannot deal with the company who will offer you a safer transaction, period. The state of Minnesota guarantees that. So anyone who wants to get a quote, please be specific in what you're asking about. Send me an email, put crush at andy@milesfranklin.com, put crush the street in the subject line. I'll beat any stated price in the industry. One last thing, we're not an online company. I am very, very set against doing online transactions. I believe gold's role in this world is analog in a digital world. I understand that. There's identity theft, there's fraud, and I just don't want any part of it. So while I'm not an online company, I believe in relationships, and I think where we're heading, relationships are important. I'll beat any price by all these online companies anyway. So you don't have to be online to be competitive. I just favor safety, protection of customer information, and not being able to be hacked. So that's why we don't do things online. That's why we do things old-fashioned, but certainly we'll beat any price, and we'll get right back to any emails that we receive from any of your listeners within 24 hours or less, guaranteed.
Well, we appreciate that, Andy, and we appreciate you. So thank you so much for coming on the show.
Yeah, love to be back again, Ken. Thanks for having me. You stay well.
You stay well, sir. Thank you.